China's financial meltdown. The $1 trillion fraud that will shock the world. Hello and welcome to our channel. Today, we'll be discussing China's financial meltdown, a $1 trillion fraud that has shocked the world. China's economy has been growing rapidly in recent years, making it the second largest economy in the world. However, there have been warning signs that its financial system is on the brink of collapse. In this video, we will explore what led to this meltdown, the potential consequences, and what it means for the rest of the world. China's financial system is indeed unique and differs significantly from the banking systems in other countries. The state-owned banks play a critical role in China's economy as they provide the majority of loans to state-owned enterprises or SOEs. These banks are also heavily regulated by the government and operate with a high degree of government involvement. One of the defining features of China's financial system is the system of implicit guarantees. This means that the government is expected to step in and bail out any bank or enterprise that runs into trouble. This creates a moral hazard problem as it encourages banks to take on more risk and engage in reckless lending practices, knowing that they will not be held accountable for their bad loans. The implicit guarantee system has led to a culture of risk-taking and reckless lending in China's financial system. Banks have engaged in practices such as evergreening, where they lend more money to troubled borrowers to help them pay off existing loans. This creates a cycle of debt that can be difficult to escape from as the borrower becomes more and more indebted to the lender. The problem with this system is that it can lead to a misallocation of resources. Banks prioritize lending to SOEs rather than to more productive and profitable private sector businesses. This can hinder economic growth and development, as resources are not being allocated efficiently. Furthermore, the implicit guarantee system has led to a buildup of debt in China's economy. The debt-to-GDP ratio in China has risen rapidly in recent years, reaching 335% in 2020. This is a cause for concern, as high levels of debt can be unsustainable and can lead to financial instability. The $1 trillion fraud at the heart of China's financial meltdown is a complex issue that highlights the dangers of evergreening and the risks associated with the Chinese financial system. The fraud involves a web of companies and individuals, many of whom are closely linked to the Chinese Communist Party. Evergreening is a practice where companies take out new loans to pay off existing debt, which allows them to avoid defaulting on their loans and maintaining the illusion of financial stability. However, evergreening is not sustainable in the long term, and eventually the debt becomes too large to service. This leads to a debt crisis and can cause companies to go bankrupt. The China Group is a prime example of the risks associated with evergreening. The company, which started as a small airline, grew into a conglomerate through a series of acquisitions. However, this growth was fueled by debt, and the company amassed over $100 billion in debt. When the pandemic hit, the company was unable to pay off its debts and was forced to declare bankruptcy. The China Group's bankruptcy was not an isolated incident. Many Chinese companies have used evergreening to fuel their growth, leading to a debt crisis that threatens to destabilize the Chinese economy. The Chinese government has recognized the risks associated with evergreening and is taking steps to address this issue. However, these steps may not be enough to prevent a financial meltdown. The fraud at the heart of China's financial meltdown is a warning to investors and companies around the world about the risks associated with evergreening. Companies should be cautious about taking on too much debt and should ensure that they have a sustainable business model. Investors should be vigilant about the companies they invest in and should avoid companies that rely heavily on evergreening to fuel their growth. The Chinese government's reluctance to address the growing financial risks in its economy has been a cause for concern for many years. Despite being aware of the issue, the government has been hesitant to take meaningful action to address the underlying problems. Instead, it is engaged in a cover-up, using its state-controlled media to downplay the severity of the situation and painting a rosy picture of the economy. This cover-up has extended to cracking down on whistleblowers and independent journalists who try to expose the truth about the financial system. In recent years, there have been reports of journalists being detained or silenced for reporting issues related to China's economy. For example, in 2020, citizen journalist Zhang Zhan was sentenced to 4 years in prison for reporting on the COVID-19 pandemic in Wuhan, including the economic impact of the lockdowns. The Chinese government's response to the financial crisis in its economy is not unique. Many authoritarian governments have a tendency to suppress information that would undermine their authority or challenge their narrative. However, the consequences of this cover-up could be severe. By failing to address the underlying problems in the financial system, the Chinese government risks creating a systemic financial crisis that could have global consequences. The cover-up also erodes trust in China's financial system, making it less attractive to foreign investors. This could lead to a slowdown in investment and economic growth, which could have a ripple effect on the global economy. Furthermore, it could harm China's own economic growth by discouraging domestic investment and undermining consumer confidence. The Chinese government's reluctance to address the growing financial risks in its economy and its cover-up of the true extent of the problem are cause for concern. By suppressing information and failing to take meaningful action, the government risks creating a financial crisis that could have global consequences. It also erodes trust in China's financial system and could harm its own economic growth. It remains to be seen whether the government will take the necessary steps to address these risks and prevent a meltdown. The consequences of China's potential financial meltdown are vast and could have severe impacts not only on the country itself, but also on the global economy. With China being the world's second-largest economy, its financial collapse could have far-reaching implications. The Chinese government's policy of propping up failing banks and companies to maintain economic stability is a significant concern. This strategy has created a system of implicit guarantees, where the government is expected to bail out any bank or enterprise that runs into trouble. This culture of risk-taking and reckless lending has led to a rapid rise in debt, with China's total debt now estimated to be around 300% of its GDP. This level of debt is alarming, and if left unchecked, it could lead to a systemic financial crisis that could spill over into the global economy. Furthermore, the Chinese government's cover-up of the true extent of the financial risk in its economy has eroded trust in its financial system, making it less attractive to foreign investors. This lack of trust could lead to a slowdown in investment and economic growth, which could have a ripple effect on the global economy. China's economic growth has been a major driver of global economic growth over the past few decades, and any slowdown could have a significant impact on that global economy. In addition, the Chinese government's crackdown on whistleblowers and independent journalists who tried to expose the truth about the financial system has created an atmosphere of fear and uncertainty. This lack of transparency could further harm investors' confidence and discourage foreign investment in the country. If China were to experience a financial meltdown, it could trigger a global recession. A major shock to the Chinese economy would have significant knock-off effects on other countries that rely on China for trade and investment. For example, a slowdown in Chinese demand for commodities could have a severe impact on commodity-producing countries such as Australia, Brazil, and South Africa. The potential impact of China's financial meltdown on the rest of the world cannot be overstated. China is the world's second-largest economy, and its economic growth has been a major driver of global prosperity in recent years. A financial collapse would derail this growth and trigger a global recession. Further, China's economic policies have had a significant impact on the global economy. Its massive infrastructure projects, such as the Belt and Road Initiative, have led to a surge in demand for commodities and boosted economic growth in developing countries. A slowdown in China's economy could have a significant impact on these countries. Thank you for watching this video about China's financial meltdown. We hope that you found it informative and insightful. As we have seen, the potential fallout from a financial collapse in China could be severe, with consequences that could be felt around the world. It is crucial that the Chinese government takes the necessary steps to address its financial risks and prevent a meltdown. As global citizens, we have a stake in the health of China's economy and financial system, and we must remain vigilant and hold the Chinese government accountable for its actions. We hope that this video has raised awareness about this important issue and inspired you to continue learning and exploring this topic further.